Welcome to Markets Now. I'm Michelle Rook along with Mike Zuzulo with Global Commodity Analytics. And grains mostly higher this morning with the exception of some of the wheat contracts over in the livestock futures, cattle staying pressure, hogs to the plus side. And Mike, let's start off talking about soybeans. You've got the nearby contracts actually scoring new contract highs here. The bull spreads have been working. What is the underlying dynamic that's going on here that's pushing this spread so wide between especially August, November?
Yeah, I think there's several things, Michelle. The biggest thing I think is the spread at August, November hitting $1.50 here as we approach the second half of the trading week. That just essentially screams to the market that the farmer in the United States is out of beans on the old crop side of the equation. And that goes in tow with these export sales that we're seeing on almost a daily basis, that these unknown sales are, I think, being expected to be from China. That suggests that China is back in the game, that Brazil's price is high. Brazil's price is high in part because the dollar is at a 13-month low against the Brazilian real. I think the other thing that comes into this in the same vein is that agro dollar that Argentina is talking about doing and moving forward with really impacts the grains more than the oil seeds. There are some sunflower, vegetable oil dynamics in this agro dollar to give a push of Argentine exports at a preferred exchange rate. But it's really about the grains, especially the corn, them upping that number from 22 to 26 million tons of potential exports of corn out of Argentina. So beans have had the best of both worlds, very tight old crop supplies, along with unknown demand on the export market, thinking it's China. And then also the fact that we've got the currency in play and the farmer in the United States pretty much out of beans.
Okay, but in addition, do you think the Chinese are concerned about the amount of drought that we have and that we're going to get a big enough soybean crop to fulfill all these export needs and demand needs?
Yeah, I think that's the next step in this puzzle because we are getting closer to the end of the month. I would think that the trade would start thinking about the next WASDE report. The Chinese probably already are. So I think you're right on the money there. I think what we have to see now, or almost have to see now, is the coming together of the beans with the grains. Even though the beans have had better demand, the weekly export sales were pretty good for the corn, especially not as good for the wheat. But we've also had the new updated agriculture and drought numbers on the same line of thinking of your yield question on soybeans. And we lost in terms of drought. We increased our drought by 4 points in corn and 3 points in beans versus last week. We're back to right at double the amount of drought of agriculture in corn and beans than we were a year ago. And I think we will start, thinking about where is this yield compared to last year? Is it closer to where we were back in 2019? That's what some of my numbers are suggesting. So, but right now, I think it's more about the bean demand and whether we can latch up the train and see the wheat and the corn get pulled up by the beans here now that we're out of the Federal Reserve window.
Yeah. So what is your thought there though? Because can soybeans lift are they the boat or the tide that lifts all boats here? Is that going to happen?
I think they are, and I'll say why. I think it's because if the dollar doesn't go screaming higher, that keeps your Brazilian currency favorable. That should help everybody. I think also
Good.
the meal market's stronger. It's
Yeah.
kind of leading now. That's supportive as well. And I think the weather models are still mostly dry for the upper Midwest through this coming weekend and triple digit heat. And I'm already hearing it from clients in parts of Iowa. They're not going to sell any more cash till they get a rain.
So weather yield, that's one part of the equation. The other part is what happens with the Black Sea War. Of course, big push the beginning of the week with the war continuing to escalate, but it seems like that market needs to have bullish news every day. And with Ukraine actually moving some grain now, we've kind of deflated the balloon here a bit, right?
Yes, absolutely. Well put. I mean, we just don't have the European markets sustaining rallies, and it feels like what we felt the last year and a half. And it's interesting, Michelle, because when we signed that grain deal when the Ukrainians and Russians signed that grain deal about a year ago, the European wheat futures in Paris we're trading about $9 to $9.50 equivalent US dollars per bushel. We're barely getting to 8. And so I really felt like going into the end of this week, if we didn't have any really negative news from the Fed, we should be closer to $8 in soft red wheat and $6 in corn, given the size of that market. But Europe is, I think, simply holding us back because we're still getting grain out of Europe from other ways, and it's still keeping a real weight on that European market.
Well, and you and I have talked before about the fact that just because the corridor was open or not open, it didn't really translate to sales for the US here. And is there thought that maybe this time around will be different, or do you not think that?
I do think it's different because we're in the 23-24 marketing year, and we are looking at a 7 to 8 year low in world wheat ending stocks. And that, I think, is going to mean something given the smaller crops, both in Ukraine and Russia, with or without the deal.
You mentioned the Fed raising interest rates 0.25% or 25 basis points yesterday. What did you see in terms or hear in terms of Fed Chair Powell's comments about what's next, what's yet to come?
They're not done. I think it was, what was it, 8 of the 12 or 9 of the 12 voting members, or it was a high percentage, like 70%. We're looking at least one more rate cut this calendar year. They come back in September. I think this really does open the door. I think we've started a manufacturing recession here in this country. China's in a recession at this point. I think this helps keep that recession going. We'll see if the services can hold up, because that's what's holding up our meat demand and our meat consumption right now. And I think that's where Q4 could be a really rough ride on the demand side, especially for those elastic, sensitive markets like soybean oil and beef and pork.
Yeah. And if you do have crude oil clear the $80 mark and keep marching higher, that's going to be tough to keep inflation down, isn't it?
That's an excellent point. That's been one of the real feathers in the cap of the Federal Reserve. They had not had to deal with a really bad summer driving fuel price, and that's really helped them do what they want to do. But I think they are pushing the button a little bit too hard at this point. And come Q4, we're going to see, I think, quite a bit of a stall in a lot of the interest rate sensitive markets, and it's going to be pretty obvious to the trade.
Yeah. All right. So the cattle market has been kind of struggling here since we put in the reversals a week ago or so. And, is that market, where are we going with it? Because it feels like we're kind of trying to reset here and figure out what the next step is, whether we're going up or down. So,
Yeah, the cattle numbers that came out last week, this market today is suggesting, without the cash market really jumping, we've got these numbers baked into the price, and we're letting the air out of the balloon since the numbers didn't tell us anything new or something we didn't think about. So bullish
okay.
numbers, but buy the rumor, sell the fact. A big number that I'm watching is the June high in August fat cattle. That's right around 178.10. If we close below that on a weekly basis, we take out a June high on a weekly basis, that takes us backwards, and that might stimulate some of these very long funds to go ahead and liquidate more. So between that and the belly season, those are the big things I'm watching, the fat cattle.
But the funds have defended their long many times here when we've had these reversals or these technical indicators, just because the supplies have been so darn tight. I mean, can we hang our hat on these technicals when you're in this kind of a market environment, especially if cash is higher again this week?
I think we can. One of the new elements out there is the drought. Missouri farmers and ranchers are already liquidating their herds in the beef cattle, from what I understand. And I think that could expand and push up our near-term marketings as we get deeper into the last quarter of the year and see that production number go up. Dressed weights are going to dictate, I think, how low we could go on a pullback and whether the funds really turn into a net short or not. If we start to see weights go up, which would be hard to envision in a drought, that might give them an impetus to change their recent manners and behavior.
And you've mentioned it a couple times now as far as hogs. They've been pushed here by this big rally in the bellies on the cash side of things. Seasonally, are we about done with that, though? And is this market going to kind of flip over?
Yeah, I was contacted by one of the major financial newspapers saying, "What is this BLT seasonal?" So I have to thank you for that, I think, Michelle. I think this is where the BLT seasonal is real. I mean, the bacon, lettuce, tomato seasonal, the bellies are up there towards their 22 highs and 21 highs in midsummer. Next couple weeks is when we tend to find that seasonal peak. I would suspect that would hold this time around, just because we are seeing the bacon prices go up some at the grocers. So my mindset is the Chinese stimulus maybe is starting to be priced into the beans and the hogs. That's why they're moving together more. And then this belly seasonal. So next couple of weeks may be one of the best opportunities to sell into the market, but stay very current, I think, as you get to the end of July.
So if the hog markets have been trading China hopes, is it going to become reality in your mind?
I do think it will, because the Chinese market did bottom, I think, this past week, and it was about a month and a half after we bottomed. And so I think both countries are tightening up on supplies. But that means probably a range-bound market if both countries are going into a manufacturing recession.
Okay. Fun to talk to you as always. Thanks so much for joining us. Mike Zuzulo with Global Commodity Analytics, and that's Markets Now.